Welcome back to another episode of Gimme Some Truth. Myself, Nate Condon, is here in the booth with Andrew and Clint, talking about an interesting topic today that I don't know that many people are familiar with, the idea of prediction markets. It has origins in investments, but it goes a lot of different directions. Clint, when's the first time, can you remember the first time you heard about prediction markets?
It was a few years ago. It's probably 4 or 5 years ago, I would say. I know they were more popular over in Europe before, and they were specifically more related to elections.
Yeah.
So, you know, if we think about it's a form of betting, I would say, but more importantly, if we zoom out a little bit, it was beyond sports betting. It's like, how can we bet on certain events?
Yeah.
And so, you know, the prediction markets were kind of born out of this idea, and a lot of it was very political, so it started with that. So, okay. And they would bet on U.S. markets too, because I think they just like to see our political system and how imperfectly perfect it is. So, you know, we've got, are the Democrats going to win? Are the Republicans going to win? And basically what it comes down into prediction markets are, it's a yes or no. It's kind of a binary choice. So either the event happens or it doesn't happen. And so, you know, will the Republicans take the House in 2024? And so it's either a yes or a no. And then it will pay out the bet once the event comes to the close. So you have things that are a little farther dated out there. You know, recent election would be, you know, is Mondami going to win more than 50% of the vote, say? And then it would be a yes or no sort of thing. And then it would settle up and pay out. So, you know, the interesting part about this is the regulation behind it and how these companies have set up in the United States. So one of the first companies that is able to do this is called Kalshi. There's a few more out there that are ready to come online. Polymarket's one big one that's ready to come online as well shortly. But Kalshi has set up these markets to trade like contracts, and they're actually regulated by the CFTC, which is the weird part about it. There's no gaming commission. It's not like a sports bet. It's actually kind of set up as like an investment contract. It's actually a derivatives contract if we want to get super technical. And so, you know, those have kind of been birthed out, and it's a new form of investing / betting that we have in the markets now that we never really had. And people don't really realize that they might be getting into something that's regulated by the CFTC when they place bets on some of these contracts.
Yeah, I think what's interesting, what struck me as interesting about it is the fact that, as you said, in Europe and in other areas, these have been around since the 1800s. Like this is not a new thing, but using it in more of a sports way as opposed to a political way, which is really the kind of the origins of it, is what makes it so different today than, you know, how it's been for the last, you know, 150 years, if you will. So
yeah, I said in my blog post, and this is kind of, you know, we've all played golf. All three of us play golf here. And, you know, you make a prediction market of like, hey, I'll bet you $1 that you're able to hit it on the green or not hit it on the green.
Right.
And so, you know, that's a yes, no. It's a binary choice. We settle up by paying the currency to each person, and then that's closed. And then we move on to the next hole and the next bet, you know, goes. So, you know, that's the sort of origin of a prediction market. Now it's a lot more organized.
Yeah. Andrew, that's a little bit of the history, paints a good picture for people that are listening or watching in terms of kind of what it is when we talk about prediction markets. How's it changed in the last, say, 3 to 5 years? I mean, what does it look like today, which is so vastly different than what it looked like? And even more so, what will it look potentially like 5 years from now, which makes it so different than what it's been the last, as we said, 100 years or so?
Well, to me, the biggest difference is just it's people have heard of it much more regularly now. Like I think about the first time I heard about this, I think it was the Barack Obama, John McCain election.
Interesting.
And they had, you know, I was listening to a radio show or something like that, or a podcast, and there was a guy on that was talking about his predictive measures and all this kind of thing. And so that was the first introduction to me. And that was probably 10 years ago. And so I think in the last couple of years, it's infiltrated other markets. Sports obviously is a big one. But so I think that's kind of the last couple of years. Future, I think, is like, it's like wide open spaces. Like anything could be in there, which is exciting. And we talk about our industry, about it being like potentially a part of someone's investment strategy or a portfolio or something like that. So I think we're moving in that direction. Bunch of hurdles I think that have to be overcome, but I think that's kind of where we're going.
Yeah, I think the key is as Clint alluded to, the fact that it's governed and overseen by, you'd say more of an investment construct than a betting construct, which is what makes it so different.
Yeah, and the taxability of it changes too there. So it's more of a ordinary income situation. So, you match up gains and losses and you have ordinary income if you end up with a gain. So it's not investable as a standpoint where it's like a short-term or long-term capital gain, but it ends up as ordinary income should you win. And then that's a little different now from gambling. Gambling used to be kind of similar to that, but now with the One Big Beautiful Bill Act starting in 2026, you can only write off up to 90% of your losses. So you can be in a situation where you can break even and still owe tax on those. So this is one kind of way that these companies are getting around that sort of tax bill. And so that's why I think that this is extremely disruptive right now to these gaming companies. The gaming companies have come, the American Gaming Association, the Nevada Gaming Council, very upset about this, as you can imagine, because as Kalshi and Polymarket move more and more into sports betting, especially, that's right in their backyard. They're very concerned about this, and how are they going to be able to compete when you have less barriers into entry now, because that was the big thing on sports betting. You have to, you had to go to Las Vegas for a while, and then you had to go to your local casinos, and now the states have started to allow it, and now you have potential prediction markets, which anybody in the country might be able to access.
Because in that way, it's not gambling.
It's not gambling. It's a futures contract basically that's being settled up. So it's an incredibly smart way of structuring these sorts of things and allowing it perhaps to be accessible for all without these sorts of, every state having their own rules and things like that. So I think that, this is big. It's really big, and it might not be net beneficial for society, but it's big, and it gives access to pretty much all.
Yeah. Andrew, what in your mind are some of the pitfalls, roadblocks, issues that they'll deal with? I think you used the phrase, kind of the Wild West, if you will. But help people understand kind of what that looks like more specifically in terms of what you might have to be careful with.
Well, I think that if our clients started to do this on their own,
sure.
I think if we use the gambling, the sports betting kind of as an analogy, the percentage of winners is so low. We all know those guys, right? And friends of ours. And so if that becomes a part of some do-it-yourselfers, like, I want to get into this prediction market bets, I think that there's an increased risk that they could be doing something outside of their expertise. And so whether that's good, because then they're going to come to their advisor and ask us for our opinion and our expertise, and now we're, we're liable. I don't know, but I think those are some of the pitfalls, is just like, not being educated enough yet. With time, I think that'll, evolve. But right now, I think it's just so early when we talk about it as if we're talking about it as an investment strategy or being a part of someone's, financial picture.
Yeah, I think what's interesting about it is you're using an investment structure to basically make gambling almost legal across the country. So then, is it gambling or is it an investment?
Well, I mean, a lot of people have come to us and told us, like, investing is gambling. And in a way,
right.
Maybe they're right a little bit, but, you are the house. If you hold stocks, you generally are going to be paid off for that. If you hold the Bills at -3 this weekend, maybe not, right? So,
right.
It's definitely a different scenario there. And also when we talk about, investability, you've got all kinds of different ways on the sports betting side that you can lose money. Here, it's maybe a little cleaner, but it doesn't necessarily mean that it's better. There's some distinct advantages that you have through prediction markets in that it's more of kind of a bid-ask spread sort of situation. There's no VIG really that they have embedded inside things. So when you deal with sports books, what they try to do is kind of marry up their sides of both bets, and then they're always trying to make money on either side. This kind of helps hack that down. It's kind of like a credit card interchange company, you know. As things have gone, those fees are going to be compressed. Well, the fees kind of gambling are more and more compressed. And so these prediction markets are going to allow the ability to actually reduce the fees. It's actually better for the consumer. But again, is it investable? I don't know at this point whether I can say, hey, this is a great investment strategy for people, because it's real short term. And you can, and to your point, Nate, you can get into options and have a load of fun in options. You're talking about kind of, you know, binary choices. In many cases, options are like that. Very similar to prediction markets in that you're trying to predict an event in a point in time when a price is going to hit. It's very difficult to kind of stick that landing.
Yeah, I think that's, and a lot of this will be figured out, obviously, as time goes on, because, you know, it's just the Wild West becomes a little less wild, if you will, as time goes on. We kind of figure it out. But Andrew, I think that's a good segue into a question I wanted to ask you, which is, if this does become a more legitimate investment strategy, if you will, or part of somebody's portfolio, I mean, how do you gauge the risk of something like this?
Oh,
I mean, you'd have to consider it to be a high risk.
Yeah, so that one of the things I was thinking about, is there going to be certain qualifications? Like right now we can offer certain alternative options, but a client has to have X net worth, or they have to be a certain level, you know, with their financial status. So it's like, is that where, are there going to be certain barriers that our clients have to get through in order to open up this market?
Yeah.
So, you know, I think there's still some things that need to be figured out as far as how do you gauge that risk. But to Clint's point, I think that is a little bit cleaner, because, you know, if it's a yes, no versus any type of variance in these, it's a little cleaner. So I'm not sure. I think that's it's kind of a TBD.
Yeah. I could definitely see an investment company out there, or investment companies, you know, making a strategy around high likelihood or real high unlikelihood types of bets, and building a portfolio where it's kind of an alternative asset class.
Yeah.
Where you're able to kind of set your prediction market, you know, sort of group there has a lot of expertise sitting there, and they're going to pick off all those like 90% yes, this is almost definitely going to happen. And so we're going to pick those easy apples off that tree. And as long as you hit enough of those, you could give yourself a decent yield. Maybe you can get a 10 or 12%, you know, net rate of return on there that's non-correlated to the stock market. So, you know, I could see there be groups. I think this is going to be offered as a strategy at some point going forward. I'm sure somebody's doing it now, but will it become a little more ubiquitous? I would say in all likelihood, yes. I mean, when we're looking at different parts of portfolios, there could be a place for that. I think it's a matter of somebody building a track record long enough where you could say, yes, I'm okay with that strategy, rather than you don't think that, you know, some 18-year-old kid is going to blow it all on, you know, the fact that the Packers are going to win the Super Bowl this year or something like that, you know.
Yeah, and I think that's a good place to kind of wrap it up, from the standpoint of we don't really know what this is going to look like in the next 12 months, in the next 5 years, even in the next 10 years, right? We really don't know. What we do know is that it's been around for a long, long time. It's not a new concept, especially to people that are outside the United States that have been doing this for you know, longer than we have. But it's interesting, and it's big enough that it feels like it's got momentum, and it probably will become more kind of mainstream, if you will, as time goes on. You know, Polymarket and Kalshi are not going to be the last two companies doing this. So as you hear more about this, just understand that we have some knowledge in this area, but it's going to be interesting for us, like everybody, to ultimately see where this goes. So thanks again for tuning into another episode of Gimme Some Truth. If you'd like to hear more about this topic or other topics, don't hesitate to let us know. Thanks so much for your time.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.